Hi, I'm Gina Martin-Adams, the Chief Equity Strategist for Bloomberg Intelligence. I want to talk a little bit today about bubbles. Clearly, over the last several years, rumors have been swirling that we're in the middle of an equity market bubble. But are we? As the title of my slide here suggests, bubble, bubble, still no trouble. Our view is, while there are some symptoms of a bubble potentially emerging in the equity market, we may only be at the very beginning of the bubble, if indeed we are in one. My first slide describes what is a bubble. But in our view, bubbles are characterized by really three main things: a dramatic upturn in prices that lacks fundamental support and is driven by a fear of missing out. This is otherwise known as irrational exuberance, first characterized by Alan Greenspan in the 1990s, major stock market advance. So let's examine these three major issues. Are we indeed in a bubble? Well, first, a bubble requires a dramatic upturn in equity prices. As you can see, looking at the major market moves of the last century, we plot in the white line the equity market advance in the 80s and 90s, against, in the blue line, the equity market advance in the 50s and 60s, and then our equity market advance since 2009 in yellow. As you can see, we've plotted right along the pace of growth of the first decade of these particular bull market advances. However, as we learned in those periods, the average bull market of the last century has been closer to 18 or 19 years in duration. And maybe we are right around the halfway point. Is there any evidence, though, to suggest that we're much further along in the equity market's advance? Our next slide actually shows, well, in comparison to the last 5 years of those major equity market bubbles, we're nowhere near experiencing a major surge in equity prices that could be characterized as a bubble. This graph shows in yellow the last 5 years of the 1990s surge. In blue, the last 5 years of the 1920s surge. And then in pink and white are the last 5 years of the 60s and the 2010s. As you can see, we have experienced a pretty significant surge in stock prices that surpasses the level of the surge in the late 60s, but it's nowhere near the bubbly conditions that existed in the 20s or in the 1990s. So the evidence is still pretty scant to suggest we've had that dramatic upturn in equity prices. Investors seem to believe, however, that the last several years have been somewhat abnormal. This particular exhibit shows average annual returns in equity prices over the last century or so have been about 11.5%. Have we had extremely strong surges even on an annualized basis? The evidence suggests no. As a matter of fact, over the last 10 years, there have really only been 2 years in which the annual return to equity prices is above one standard deviation beyond long-term average. In the 50s, we had 4 of those years. And in the 80s, we had 3. So early bull market advances do tend to be characterized by much stronger surges in equity prices. We haven't had such an occurrence. So dramatic upturn, the jury's still out, but generally I would suggest that the evidence is not really supporting the case that we've had that big dramatic upturn in equity prices. My next segment is about fundamentals. Now here we have experienced maybe a little bit of evidence that we are in an equity market bubble or one is emerging, because we have seen prices detach from fundamentals. If you define fundamentals as purely economic conditions and earnings conditions. Indeed, this graph shows that relative to prices, earnings have certainly fallen short. Prices, of course, the white line on this graph for the S&P 500, earnings, the yellow and green lines. But frankly, most of the equity market advance has been supported by extremely low interest rates. One might also characterize interest rates as a fundamental condition. This graph shows the equity risk premium is actually still well above long-term average. In fact, it's significantly above levels where it troughed in the 60s and in the 2000s. As you can see, the equity risk premium here is well above negative territory. In the 2000s, the equity risk premium stayed in negative territory. This is, of course, the risk premium on stocks in comparison to the 10-year Treasury yield. So investors are still commanding a pretty tremendous premium to get into risk. That's not the typical environment that you would see in a bubble. My next exhibit shows our models based on fundamental conditions, including interest rates as well as earnings growth. Our models suggest there's still about 10% upside even in the short term for global equities. This is based upon an anticipated improvement in economic conditions over the next year, but interest rates remaining relatively low. Certainly, US stocks in our models have less upside than some of the riskier areas of the market. But what you would normally see in a very risk-tolerant environment is the riskier areas of the market growing faster. You would see much greater absorption of a much greater interest in equity investment in the riskier segments of the world. And that's not what we're seeing so far. As a matter of fact, there's still significant upside in non-domestic equity markets, in our view. Now, on to the third fundamental. Is there really a fear of missing out? Obviously, over the course of the last year or so, investors have become somewhat captivated by the day-to-day moves in equities, and specific equities in the equity market have become very popular. We've seen retail investors add more to stocks over the course of the last year or so. Some of this may be a function of little else to do in a stay-at-home environment. Some of it may be an evolving gambling sort of culture. But frankly, when we look at the aggregate, there really isn't a ton of evidence to suggest that investors are flooding into stocks. As a matter of fact, this particular graph shows the long-term perspective of US household ownership of equities. The blue line is household ownership of equities at large. This shows that households have experienced increasing equity valuations over the course of the last 10 years. But when you exclude the impact of price changes, that's the white line on this graph, households have really barely added to their equity exposure at all. Indeed, we've seen equity valuations more than triple over the course of the last 10 years, and yet ownership share really hasn't increased. So while households are riding the wave of the equity market and enjoying the returns on the stocks that they've owned for a decade, they haven't been adding to those positions. We see this evidence emerge even more when we look at flows into the equity market. This particular exhibit shows flows into stocks relative to bonds. As you can see, flows into bonds have massively overshot flows into equities. Even over the course of the last year, equity inflows have been very scant in comparison to bond inflows. We've seen flows pick up a bit in 2021, but it still is remarkably slim relative to the long-term history. And then finally, are investors really irrationally exuberant about the equity market? This particular exhibit shows State Street's Investor Confidence Survey. You might note that investor confidence is not necessarily at a peak level. Back in 2000, investor confidence was extremely high. The survey result was near 140. We're still below 100, suggesting that investors are maybe just digging out of a low confidence level. In sum, we think that the equity market may be starting to exhibit some signs of a bubble, and certainly on at least one measure have detached from fundamental concerns. But as long as interest rates remain very, very low, and frankly, as long as investment is only just starting to pick up in stocks, it's really difficult to characterize the equity market outlook as bubbly. Thanks so much for joining me this week.